What's up guys, it's Matt. This video will be part 3 of where I teach you how to understand candlestick charts as a technical trader. So if you haven't watched part 1 or 2, be sure to check those videos out first. The links will be in the description to them, and if at any point in time you find this video helpful, be sure to drop a like and subscribe to this channel. So in this part, we'll begin by talking about the different types of candlestick patterns that a lot of traders are typically exposed to, especially beginners when they first start trading. So I'm sure many of you have seen charts like this before, so you'll see tweezer tops and bottoms, hammers or shooting stars, inverted hammers, and some of these are reversal candlestick patterns and some of them are continuation patterns. Now the issue with these candlestick patterns is that a lot of traders will only memorize them without making any context of where they appear and what the price action in the actual market is doing. And that's because simply memorizing these patterns for trade entries is not the only thing that will help you if you don't also understand price action and other factors that are in the market. So if we were to look at an example, so right now I'm on Ethereum and I'm on the daily chart, but if we look at this most recent candle, a lot of traders, especially beginner traders who memorized all the different types of candlestick patterns or setups, a lot of them would simply look at this and say that this is a hammer pattern or a hammer candle or a pin bar candle, so whatever term you want to use. But essentially they would look at this and say that, okay, the body is much smaller than the wick. So we have a wick that's essentially, in this case, 5 times larger in size compared to the body, right? And the wick is above the body, meaning that initially we had bullish strength and then we had bearish strength, and that's why this candle closed with a large wick to the upside. So essentially this means that we should sell. So many traders would take this as a sell signal, and this is where they might enter a sell position because they memorized different types of candlestick patterns. So if we actually look at the price action, so we'll start with this daily chart, we can see that some traders might have drawn perhaps a trend line here, which essentially means that we created this bearish impulsive move, we corrected a bit, we created another push to the downside, but this time it took a bit longer for this to play out compared to this move over here. And then the third bearish push to the downside once again took quite some time to play out, and we were rejecting this weekly level multiple times. So this weekly level, which is at around $2,000, perhaps a bit below. If we were to look at the price action history, we can see that this region has been rejected multiple times, and that right now we were actually forming the next weekly candle above this previous bullish weekly candle, meaning that there's a greater probable likelihood that the next push will be a push to the upside. So this daily trend is more likely to continue going up. And so we can see that that's exactly what ended up happening. And so by understanding the overall market structure and seeing where this pin bar candle or where this hammer candle, where this actually occurred, understanding this is more important than simply memorizing these candlestick patterns and just blindly buying or selling whether or not you see them. Now, another point that I wanted to make when it comes to these traditional candlestick patterns is that they're all very similar, except the difference here depends on which time frame you might be looking at. So what I mean is that let's zoom in and look at this hammer pattern over here, which traditionally would be a bearish signal for those of you who are looking at it this way, where this is either a bullish or a bearish reversal setup. Anyways, if we think about this for a second, what you essentially have is within a single period of time. So let's say this is the 2-hour chart. Let's assume that between, I don't know, 10 o'clock and 12 o'clock, price action opened over here. We pushed to the upside, so we created this wick, and then we pushed to the downside, and within 2 hours we moved up, we moved down, and we closed down here. Well, now let's take a look at this engulfing candle down here, which would be essentially another reversal setup if you're someone who's looking to sell. Now, as I mentioned previously, you don't just want to look at these as confirmations to either buy or sell. There's more to it, which ties into price action. But if we think about this again, let's assume that if this was the 2-hour chart, now we're looking at the 1-hour chart. So price action opened over here, we pushed to the upside, we closed over here, and again, let's assume that we're between 10 o'clock and 12 o'clock. So at 11 o'clock, we would have closed up here as a bullish candle. And then once 11 o'clock hits, this next bearish candle starts to form. And then we drop to the downside and we close over here at 12 o'clock. Well, what's interesting is that you will see that these are essentially the same thing, except this hammer pattern is forming on a higher time frame compared to this engulfing pattern, which is forming on a lower time frame. And so now if we take a look at something like tweezer tops or tweezer bottoms, which is another traditional reversal candlestick pattern that a lot of beginner traders will memorize. If we think about this, if both of these setups are, let's say, on the 2-hour chart, so this candle over here formed at 10 o'clock, let's say it closed at 11, and then this one opened at 11 and it closed at 12. Well, if we think about this, if we were to drop down to a lower time frame, so just picture this in your mind. So imagine maybe the 1-hour chart or the 15-minute chart. Well, what this essentially would look like is a double top or a double bottom. And that's because we opened over here, we pushed to the upside, we dropped down again, we closed here. So this would be your first top, essentially. And then we push to the upside, we match the top, so we match the high, or it might be a very similar high. And then we drop down and we close down here. So some traders might call this an M formation. Other traders, if they look at the tweezer bottoms, which is essentially the same thing but upside down, this would be a double bottom or a W formation. So there's many different concepts and many different names for this. But essentially, by understanding the price action, you will know that on a lower time frame, all we essentially have is we have a push to the upside, a drop down, another attempt to push to the upside, we match the high, and then we drop down. And so now if we look at other candlestick patterns that are very similar, we'll see that essentially we have the same thing. So if we compare the tweezer tops, let me zoom out a little bit. So if we compare the tweezer tops to perhaps this evening star pattern, which is also a common one that traders memorize. Let's say we push to the upside, we close, so we closed over here. We pushed up again, we formed this wick, we push down. Let's assume we push up again, and when we drop down, this is where this bullish candle closes, and now this bearish candle opens, and then we push down again. So it's essentially the same concept, but it might look slightly different depending on which time frame you're looking at. Let's also take a look at something like a traditional inside up or inside down pattern. What you basically have, so if we think about the market structure, is you have price action pushing up, it forms this high, we drop down, we create this low, we push up again, we close over here, we push up, we drop down, we create essentially an equal or similar low, and then we push up, we create this high, and then this higher low for this next candle, and then we push up again and create another higher high. So essentially we have a high, we drop down, we create a double bottom, and then a higher high, higher low, and then another higher high. So essentially this is a shift when it comes to price action, where initially you had equal lows and a lower high, but then you flipped to having higher highs and higher lows, which is why, again, on another time frame, this might look like a reversal setup, but what's important is understanding where this appears. So hopefully you guys found this video helpful. If you did, I would appreciate it if you dropped a like on this video, and be sure to check out my trading community. The links are in the description to the Discord app and the Telegram app. Thanks for watching. I'll see you in the next one.